This Chapter 1 reviews some of the accounting and regulatory rules that relate to an issuer's equity and the principal drivers of transactions involving issuer's own equity. From the balance sheet perspective, outstanding common shares form part of the issuer's equity account, which has important consequences for the issuer's financial ratios, particularly the various ratios used to measure leverage and profitability. One measure is the simple debt-to-equity ratio, which declines as the issuer's outstanding equity increases. Other measures used by credit analysts and rating agencies and in loan covenants imposed by lenders are debt to EBITDA, which worsens the more the issuer finances himself with debt rather than equity. Another key ratio analysts and investors use to monitor a company's financial condition, particularly for purposes of equity valuation, is earnings per share, or EPS, which essentially takes the issuer's net income after taxes and divides that by the total number of shares outstanding. This time, the more shares the company has issued, the lower its EPS, all other things being equal, illustrating the natural tension that exists for any issuer between having too much equity and too little. Too much equity pulls down EPS and makes the company less attractive from the shareholder perspective, while too little equity achieves benefits from the EPS perspective, but worsens the various leverage measures, drags down the issuer's credit rating, and increases its cost of debt. Issuers therefore search for the so-called sweet spot in their capital structure, the point at which the issuer is using enough debt to avoid damaging its EPS figures too much, while abstaining from excessive leverage to keep its credit rating at a reasonable level and its cost of debt acceptable. A natural bias in favor of debt results also from the deductibility for tax purposes in most jurisdictions of interest payments, something that is not typically available for dividend distributions on common shares, or for that matter on preferred shares. A measure often used to optimize the debt-to-equity proportion is the weighted average cost of capital, or WACC. The formula for WACC, which recognizes the tax benefits of debt from the issuer's perspective, is this formula here, where KD is the issuer's cost of debt, T is the issuer's marginal tax rate, KE is the issuer's cost of equity, D is the total amount of debt the issuer has, and E is the total amount of equity. Debates arise on whether to use the face value or market value for D and E, but these are outside the scope of this module and will be addressed separately in our modules in corporate finance. Debates also outside the scope of this module address the best method for measuring the cost of equity, with various techniques such as the capital asset pricing model among the more common, but all having their critics and their weaknesses. Analysts search for the optimal capital structure by plotting the issuer's WACC against its total debt expressed as a percentage of total capitalization, i.e. as a percentage of total debt plus total equity. We illustrate the trade-off revealed by this analysis by means of the following example. We suppose first that the company has very little debt, amounting to only 10% of total capitalization, and causing the company's cost of debt pre-tax to be very close to the risk-free rate at 5%, say. We assume somewhat arbitrarily but not unreasonably a 12% cost of equity and also a quite realistic 40% marginal tax rate for the company. We calculate the company's WACC as follows. Here is the formula from above, with the 5% cost of debt, 1 minus the tax rate, 10 over 100 the ratio of debt to total capitalization, and then on the right 12% the cost of equity, and 90% the contribution of equity to total capitalization. And as you can see, this comes to 11.1%. We next proceed to replace some of the company's equity with debt, make new assumptions about how this change in leverage affects the cost of debt as well as the cost of equity, and search for the sweet spot or optimal leverage ratio. Assume first that the company replaces 20 percentage points of equity with debt, and that its credit rating declines in consequence by a couple of notches, increasing its cost of debt to 6%. Perhaps not surprisingly, the company's cost of equity also typically rises under most models used by practitioners to estimate this item. This is because the cost of equity includes, among its inputs, measures of the stock's volatility, directly or indirectly, an input that will increase as the company's leverage increases. Somewhat arbitrarily, again, we assume that the cost of equity now rises to 14%. It comes as a surprise to many people that, despite the increase in KD as well as KE, WACC itself declines in the present example. Specifically, WACC, using our formula once again, turns out this time to be 10.88%. A moment's reflection should reveal to you that despite the increase in the cost of both debt and equity, the more important change has been the reduction as a proportion of the total of the far costlier type of security, especially on an after-tax basis, namely equity, for which the previous weight of 90% has been replaced by the lower 70%, and by extension the increase in the weight of debt, which is the far cheaper security of the two, from 10 to 30%. The favorable change in these two proportions has outweighed, mathematically speaking, the simultaneous increase in the cost of each item on a standalone basis, pulling down WACC by around 0.22%. Our previous results appear in this table here. We now show two more examples to complete this analysis. One in which debt and equity each represent 50% of total capitalization, with debt now costing 7% and equity's cost rising to 16%. And a second example in which debt is now 80% of the total, effectively turning the company into the typical highly leveraged outfit that often emerges from an acquisition by private equity groups, causing the company's credit rating to drop far below investment grade, to single B, let us say, and increasing the cost of debt to 12% and the cost of equity to 25%. The corresponding calculations of WACC turn out to be the following. You will note that WACC appears to bottom out under the third scenario at 10.10%, before starting to rise again when the company's leverage has become so high that even the tax deductibility of debt, which now represents 80% of total capitalization, cannot offset sufficiently the substantial increase in the cost of both debt and equity. Our sweet spot in this simplified example is located somewhere around a 50-50 proportion of debt and equity. Interestingly, many studies confirm the main point of our analysis. Companies seeking to minimize WACC should avoid excessive amounts of expensive non-deductible equity and replace some of that equity with cheap tax-deductible debt, but should refrain from over-leveraging themselves because at some point the benefits from the use of debt are outweighed by the offsetting factors we have discussed. For corporations in the industrial sector, many studies suggest that WACC is indeed minimized when the issuer's credit rating declines to somewhere around single A minus or triple B plus. For regulated entities, such as banks and insurance companies, the analysis is not as simple, since a credit rating below a very high level, while potentially continuing to reduce WACC, may damage the institution's business in other critical respects. A bank rated below single A, for example, is often unable to pitch for lucrative derivatives business, given its unacceptable credit risk to counterparties. Similarly, it may become ineligible as a provider of guarantees or letters of credit in trade finance, structured finance, project finance, and the like. Finally, it risks violating key regulatory ratios, which could result in diminished powers as a banking institution and increased costs in various respects. Our analysis above would need to be accompanied by quantitative and qualitative adjustments to reflect these realities. Returning to an issuer's key financial ratios, we now discuss the concept of contingent equity, and specifically the role played by instruments that do not yet represent outstanding common shares, but may do so in the future. The most common examples of these include the following: employee stock options, which turn into common stock over time, provided a number of conditions are met, often including the continuation of employment for the holder and the achievement of some specified minimum performance by the company's share price or some other measure of success. Convertible securities, discussed extensively in our module on convertible instruments, which include a variety of structures that alternatively convert at the holder's option, that of the issuers, or sometimes automatically upon the passage of time, and a variety of derivative contracts entered into by companies which may require the company to issue common shares to its counterparty under specified circumstances, including forwards, options, and total return swaps which settle with physical delivery of shares. For accountants, analysts, regulators, and credit rating agencies, the question is how much to reflect these contingent share issuances in the company's financial statements, whether beneficial or detrimental to the relevant financial ratios, and also how much the likelihood of issuance should play a role in determining whether to include these contingent shares in the ratios or not. As with all accounting questions, the answers are extremely complicated. They vary enormously with context, issuer, jurisdiction, and over time, and therefore they cannot be touched upon except superficially in a module like this one. We list below a few rules that are generally correct for most of the above purposes. 1. Basic EPS calculations generally do not reflect contingent share issuances from employee stock option programs, but the alternative measure of EPS, known as diluted EPS, normally does. 2. Leverage ratios, as determined by accountants and regulators, typically treat all debt instruments principally as debt, including debt instruments that are convertible into equity at the option of the holder, even when this option has gone deep in the money. Little or no equity credit is granted until the instrument actually converts into common shares. 3. Instruments that convert into common shares at the option of the issuer, or automatically once a defined amount of time has passed, are more easily accepted as equity by regulators, accountants, and most analysts. 4. Credit rating agencies do not bind themselves to such rigid rules and prefer to look at each case on a standalone basis, sometimes taking into account the likelihood that the contingent common shares will be issued. And 5. Derivative contracts on the issuer's underlying common shares may also need to be included in the measurement of diluted EPS, at least when they settle via delivery of shares versus on a net cash basis. Note that the above rules are not consistent with each other in all cases, and are sometimes inconsistent even within one framework. Under U.S. accounting, for example, a regular convertible bond is treated entirely as debt for balance sheet purposes, and yet is reflected to some degree as equity in the calculation of diluted EPS. We will discuss this point in more detail in Chapter 4. But for now, we have reached the end of this Chapter 1.